Welcome back to Iron Financial, everybody. This is the explainer you need to forge a stronger, more resilient portfolio and completely cut through all the market weakness we're seeing out there. I'm your lead analyst, and as always, I'm sitting right here with the market skeptic. Listen, before we dive in, make sure you hit that subscribe button right now, because today we are doing an institutional-grade deep dive breakdown of a stock that just threw Wall Street for an absolute massive loop.
That's exactly right. Today we are putting Netflix's Q2 2026 earnings directly under the microscope. And guys, here is the core conflict, the big mystery we have to resolve for you today. Netflix actually hit its financial numbers. Literally, the quarter was not an absolute failure on paper. Management provided forward guidance of $12.56 billion in revenue, and guess what? They hit $12.56 billion right on the nose. Then, they were expected to deliver 79 cents in earnings per share, and they came in at 80 cents. They beat consensus by a penny. Look, in this macro environment, hitting revenue to the exact decimal and beating the bottom line, that should be celebrated. Yet Wall Street immediately dumped this stock like it was a completely toxic asset. The question is, why?
Yeah, just look right at this post-earnings bloodbath. We are looking at a brutal, violent 8 to 9% after-hours drop. That massive red candle you see there, that pushed the stock all the way down to a 52-week low. When a drop like this happens so violently and so quickly, that isn't retail selling, that is pure institutional panic. We are talking about billions of dollars in market cap that simply evaporated in minutes, completely wiping out months and months of hard-fought equity gains.
It is incredibly ugly to watch. Honestly, when you see a high-flying tech and entertainment stock gap down this hard and fast, your first instinct as an investor is that the entire foundation is collapsing. The market psychology shifts in a split second. Traders are suddenly pricing in an absolute disaster, assuming there's got to be some hidden landmine buried deep in the forward guidance. But here's the crazy part. When we actually pop the hood and look at the earnings print itself, the reality just doesn't neatly match the panic we're seeing on the screen.
And that brings us to what I call the post-earnings paradox. Think about this for a second. How does a company hit its $12.56 billion revenue guidance right on the mark, actually beat consensus earnings expectations by a penny, and still trigger a complete, unmitigated market panic? It fundamentally defies all standard earnings logic, right?
Well, it's a classic case of the market looking entirely past the headline numbers. Wall Street isn't trading on what Netflix accomplished in Q2. They're trading on what the internal metrics are signaling about Q3, Q4, and really the years ahead. There's some real structural tension under the hood of these financial statements. The algorithms and the institutional desks are spotting something in the foundational data that they absolutely despise. Let's break down exactly what that is.
Section 1. Cracks in the foundation. The deceleration problem. All right, we need to initiate a real cross-examination right now on whether this streaming giant has finally hit a structural growth ceiling. Because if you look at these descending stairs of revenue growth, wow, this is the deceleration problem staring you right in the face, and let me tell you, it is exactly what Wall Street is so terrified of. Back in Q1 of 2026, Netflix grew revenue at a very healthy 16.2%. Fantastic, right? But then, in this current quarter, Q2, it drops to 13.4%. And it gets worse. Management just guided Q3 2026 growth down even further to 11.7%. You guys, this is a multi-quarter cooling trend. We have to ask the really hard questions here. Was the page sharing initiative, the whole massive password crackdown, was that just a one-time sugar high? Because it really looks like that initial burst of forced revenue is fully matured and worn off. And now that the sugar rush is over, it appears they are left with absolutely no organic growth engine to keep compounding at those premium tech multiples.
Okay, look, you're not wrong to point that out, but let's not act like the sky is falling here. A company operating at this massive, global scale literally cannot compound at 16% forever. It defies the laws of large numbers. So let's look at where the growth is actually happening beneath those top-line deceleration concerns.
Let me defend the foundation for a minute by firing back with some serious load-bearing metrics. Just look at the regional breakdown. They delivered double-digit revenue growth in literally every single operating region on the globe. The US and Canada were up 10%, EMEA was up 14%, and by the way, that region just surpassed the $4 billion revenue mark. Latin America soared a massive 21%, and the Asia-Pacific region grew 16%. I really want to highlight that 21% growth in Latin America specifically. That is incredibly impressive because they achieved that while fighting severe foreign exchange currency headwinds and fierce local competition. That isn't a sugar high, guys. That is structural, global strength. It is absolute proof that they can price their product effectively in vastly different economies. That's not a sign of a business in terminal decline. Sure, okay, the regional growth looks fine in a vacuum, but it is decelerating across the board compared to previous highs. The UCAN growth of 10%, that only reflects a partial quarter impact of their recent price hikes. What happens when that pricing power runs out and consumers finally say enough is enough and push back?
Well, management is telling us the runway is still massive. According to the data right here, Netflix claims they are under 45% penetrated into an 800 million addressable household market worldwide. Furthermore, they estimate they hold just 5% of the global TV view share. The addressable market is still wide open for them to capture. They have plenty of green space left before they hit any sort of absolute ceiling.
I hear you, but is that real actionable growth potential? Or is that just a theoretical ceiling calculated in a boardroom to keep investors dreaming? Because Wall Street clearly didn't buy the "we're just getting started" narrative this week. The market is demanding proof, and Netflix, well, they just decided to turn off the lights. I think I know exactly why the street lost trust. Let's move to the real controversy.
Market Skeptic. Section 2. The Transparency Black Box. What is management hiding? Okay, this brings us to the market's biggest anger point and the true climax of the tension we are seeing in the stock price right now. Let me verbally tear this quote from the shareholder letter apart. Management is claiming they are shifting their massive viewership report to an annual release to, quote, keep the focus on our primary financial metrics like revenue and operating profit. Are you kidding me? This corporate spin is absolutely maddening. Think about what they are trying to do right now. They are actively building a $3 billion advertising business. Advertisers and investors absolutely need to know exactly how much time people are spending on the platform. Advertisers literally buy attention. If you hide the engagement data, you're blinding the very ad buyers you're trying to court, and you are totally blinding your shareholders. We have to wonder, is this spin just a desperate cover-up for a decaying, mature product that is bleeding eyeballs to YouTube and TikTok? You're calling it a cover-up. I call it a transition to a mature enterprise model that wants to be valued on actual cash flow and profits, not just raw eyeballs. Netflix is telling the market to grow up and look at the bottom line. But let's look at the history of how we got here to understand the market's frustration. Right, and this timeline brilliantly illustrates the problem. This isn't just a one-off decision. It is a calculated, multi-year pattern of obscuring metrics. Back in April 2025, they stripped away regular quarterly subscriber counts, telling us it wasn't the best indicator of business health anymore. Okay, fine. Then they threw us a bone with a biannual engagement report tied to earnings. But now, in July 2026, they are cutting that down to an annual release starting in 2027, completely decoupled from earnings entirely. They have structurally made it harder for anyone outside the company walls to verify if the core engagement story is intact. Look, when growth slows down and transparency shrinks at the exact same time, massive alarm bells ring.
I hear the frustration, and yeah, the optics aren't great. I'll definitely give you that. But look at the actual data they did provide for the first half of this year. It completely contradicts your whole theory of a decaying product losing eyeballs.
The crucial point is right here in the data. In the first half of 2026, members watched more than 97 billion hours of content. That's up 2% year over year. That is actually a slight acceleration compared to the 1.5% growth we saw back in 2025. And they pulled that off despite facing massive, and I mean massive, competitive headwinds from both the Winter Olympics and the World Cup dominating global screens this year. With standout titles like Harlan Coben's I Will Find You and the animated hit Swapped, the actual engagement is holding totally firm. The shift in reporting isn't a cover-up, it is simply a mature pivot toward revenue-based execution. They want you looking at the cash, not the couch time. Look, a 2% growth in viewing hours isn't exactly setting the world on fire when you are guiding for 13 to 14% full-year revenue growth. There's a massive disconnect there. But fine, let's move away from the viewing hours and talk about the hard financials.
Section 3. Heavy Lifting, Financial Armor and Margins.
All right, this is where I bring out the heavy artillery to showcase the absolute, undeniable strength of Netflix's balance sheet. $4.7 billion. Let me just hammer home this record-breaking Q2 stock buyback figure. This is their largest single quarter of share repurchases in company history. And they aren't even close to done. They currently have $27.1 billion of capacity left in their authorizations. That $27 billion is a multi-year structural floor they are putting right under the stock price. This is an absolute masterclass in capital efficiency, utilizing their financial fortress to return excess cash to shareholders. Guys, you do not buy back nearly $5 billion in stock in 3 months if your internal metrics tell you your foundation is cracking.
Oh, I'm going to push back incredibly hard on this masterclass narrative. Seriously, is dropping $4.7 billion on your own stock simply an expensive patch to artificially mask a slowing core business? Let's explain the actual math behind this to our audience. If you can't organically grow top-line revenue at 16% anymore, what do? You buy back massive amounts of your own stock to reduce the overall float.
Fewer shares available in the market means your earnings per share artificially goes up, even if your actual net income growth is stalling out. You are masking the structural decay. That is financial engineering, pure and simple. It isn't organic operational strength, it is a billion-dollar band-aid over a bullet hole. It is only considered financial engineering if the underlying operations aren't highly profitable. A sinking ship doesn't generate this kind of excess cash to spend. Netflix's operations are incredibly profitable right now. Let's look really closely at the margins. I call this the operating margin rebar. It is the solid steel holding these financial statements together. They posted an operating margin of 33.4% for Q2. That actually beat management's own internal guidance of 32.6%, and it is sequentially up from Q1's 32.3%. Now yes, it is slightly down year over year, but they explicitly told us in previous letters exactly why this happens. Their content amortization is heavily front-loaded in the first half of the year. This means the heavy accounting expenses of their big blockbuster releases hit the books early, temporarily weighing on the margins. Despite that heavy front-loaded expense, the profitability remains totally exceptional.
But hold on, if the profitability is so exceptional and the rebar is so strong like you say, why did net income drop a staggering 35.6% quarter over quarter? You can't just ignore a massive plunge in actual profit.
Okay, we have to visually clear up this distortion right now, and I am very happy to dismantle this bear argument. That 35% drop is total, complete noise. Q1's net income was artificially skewed by a massive one-time $2.8 billion termination fee that Warner Bros. Discovery was legally obligated to pay them. Nearly 40% of Q1's profit came from that one-time windfall, not regular monthly subscribers. When you strip out that breakup fee and look at the real operating business, the underlying earnings per share of 80 cents this quarter is actually up 11.1% year over year. The core earnings power is absolutely steel-plated once you remove the accounting noise.
I completely refuse to yield on the cash flow, though. Just look at this table for the cash flow stress test. Free cash flow plunged all the way down to $1.5 billion this quarter. And look at the debt. Net debt rose dramatically from $2.1 billion to over $5.2 billion in a single quarter. Why? Because their massive stock buybacks outstripped their actual cash generation. They burned through cash. And remember, we are in a higher for longer interest rate environment right now. Seeing a company's net debt spike by over $3 billion in 3 months while top-line revenue visibly slows down is incredibly dangerous. It is a cash flow stress test they are barely passing, and frankly, it makes that financial fortress look a lot more vulnerable.
But they are still confidently guiding for $12.5 billion in free cash flow for the full year. They have the liquidity, and their capital allocation strategy moving forward is highly targeted and remarkably efficient. Just look at what they are doing with live sports.
This shows their highly efficient capital allocation and perfectly proves my point about them operating as a mature enterprise. Get this, live sports programming will account for just over 5% of their total content spend in 2026, and only about 1% of their total view hours. Yet those live events accounted for 6 of the top 10 new member sign-up days over the last 5 years. They aren't just blindly throwing billions at random movies anymore and hoping something sticks. They are using a sniper rifle. With massive events like the NFL and WWE coming up, they are surgically buying high ROI sign-ups with minimal proportionate spend. That is brilliant operational execution from a company that knows exactly how to convert capital into subscribers.
Section 4, the iron verdict. Bringing it home for the portfolio.
Okay, we have vigorously debated the numbers, the cash flow, the slowing growth, and the massive buybacks. It is time to synthesize this high-tension debate. When we weigh the bull and the bear, the bull case relies on powerhouse cash flow, again, $12.5 billion expected for the year, improving operating margins, and a historic $4.7 billion buyback that proves management internally believes the stock is deeply undervalued at current levels. My strongest point remains that operating margin rebar. When you are pushing 33.4% profitability, you have a durable financial fortress. And the bear case is staring at undeniable multi-quarter slowing revenue growth, combined with a deeply concerning transparency black box and rising net debt in a high-rate environment. My strongest point is simple. When you intentionally hide the viewership data right at the exact moment your top-line revenue growth is cooling down, you invite the market to assume the absolute worst. The lack of transparency breeds institutional panic. So what is the definitive verdict? Is NFL stock a steel-plated cornerstone currently trading at a massive discount, or are we looking at a structural crack in the entertainment empire's armor? My verdict?
The foundation is absolutely solid. Wall Street is completely overreacting to the transparency changes and missing the fact that Netflix is compounding double-digit revenue globally while aggressively expanding margins. This panic sell-off is a clear, rare buying opportunity for long-term investors who want a legitimate financial fortress in their portfolio. Market skeptic? And my verdict? Proceed with extreme caution. The financial engineering of the massive stock buybacks is artificially boosting earnings per share and masking the stark reality that organic top-line growth is actively cooling down. Without the regular engagement data to prove otherwise, I am watching those cracks in the armor very, very closely. The numbers are laid out, the armor is tested. But we leave you with this final thought. If Netflix truly believed their engagement was accelerating and their foundation was flawless, would they really be locking the most important data in a black box? Let us know your verdict in the comments. Thanks for joining us for this explainer. Make sure to hit that subscribe button and we'll see you in the next breakdown.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research and talk to a professional